Opendoor Technologies, ticker OP, is currently trading at $8.52, up 4 cents, which is a gain of 0.47% in today's session. Now, the instant reaction to that tiny green number might be relief or just noise. The common expectation for Opendoor is, and has always been, remarkably simple. It's a direct proxy for mortgage rates. Rates go down, the stock goes up. Rates go up, the stock goes down. But the reality of what is happening under the hood, why the stock is churning around the $8 mark instead of being at $2 or $20, is so much more complicated than that single data point. The market is slowly, painfully processing a much deeper truth. Opendoor's primary challenge heading into next year isn't just the cost of capital, it's the catastrophic lack of inventory. The iBuying machine, this vast, data-driven enterprise, is being starved of the very product it needs to function. It's not that the engine is broken, it's that the fuel lines are empty. This changes the entire thesis from a simple rate recovery play to a much more complex structural problem within the housing market itself. Let's be clear about the narrative that got us here. For the last few years, especially during the zero interest rate environment, the story sold to investors on platforms from Robinhood to SoFi was one of inevitable disruption. The expectation was that Opendoor was the Tesla stock of real estate. You had an antiquated, high-friction, agent-dominated industry, and here was a tech company with brilliant data scientists ready to replace it all with a simple, clean, all-cash offer. It looked like the future. People using online investing tools for the first time, perhaps opening a SoFi Invest account, saw a stock that was supposed to do to the local realtor what Amazon did to the bookstore. They weren't buying a home flipper, they were buying a technology platform. This was the dream, and it's what propelled the stock to absurd heights post-SPAC. But that dream, that clean narrative, slammed headfirst into the brutal reality of 2022 and 2023. The Federal Reserve's aggressive hiking cycle exposed the model's critical flaw. It turns out that when you train algorithms on a decade of nothing but rising home prices, they perform very poorly when prices suddenly reverse. Opendoor was caught holding billions of dollars in inventory that was declining in value by the week. They were forced to liquidate, torching their balance sheet and investor confidence along with it. The reality is that this was never a pure software business. It's a capital-intensive, low-margin, high-risk logistics business. It's about managing physical assets, contractors, and carrying costs. The tech part is just the pricing engine, and that engine was proven to be flawed in a downturn. What we're seeing now, with the stock clinging to life, is the market's attempt to figure out if the company has truly learned its lesson or if it's just waiting for the next bailout from a macro trend. Let's analyze the trading action we've been seeing recently. This $8.52 level isn't arbitrary. If you look at the charts on your Fidelity trading platform or the Interactive Brokers workstation, you'll see it's a key area of contention. We're seeing significant volume spikes on days with major bond market moves, particularly movements in the 10-year Treasury yield. This confirms that for now, algorithmic traders and macro funds are controlling the daily swings. They aren't trading Opendoor. They are trading a housing market ETF proxy. This is a problem for anyone trying to do fundamental self-investing. Your entire thesis on the company's improving unit economics can be completely obliterated because a CPI report came in 0.1% hot. This is the level of volatility usually reserved for things like Robinhood crypto trading, not a company supposed to be stabilizing a multi-trillion-dollar asset class. The institutional activity is just as telling. While many retail investors, perhaps using the Robinhood app for its simplicity and fractional shares, are betting on a 10x return, the smart money is treating Opendoor with extreme caution. We aren't seeing massive sovereign wealth funds or conservative pension plans, the kind that fill their books with Fidelity mutual funds or Fidelity ETFs, taking major stakes. The holders are primarily funds that specialize in high-risk, high-reward scenarios. Why? Because the risk profile is unlike anything else. When you buy Apple stock or Nvidia stock, you're buying into businesses with enormous gross margins, intellectual property, and massive cash hoards. When you buy Opendoor, you're buying a company whose primary asset is a highly leveraged, illiquid portfolio of single-family homes. It's an investment that requires a strong stomach and a deep understanding of housing microdynamics. The last earnings report was a perfect example of this expectation versus reality tension. The expectation was for a story of continued growth and recovery. The reality was much more nuanced and, frankly, more concerning. Yes, the contribution margins were better. This is critical. It shows they have become far more disciplined. They are no longer buying high and selling low just to show revenue growth. They are protecting their margins on each transaction. That's the good news. The bad news? Revenue continues to be deeply suppressed. And why? Because their acquisition volume, the number of homes they are actually buying, is a fraction of what it was at the peak. They have fixed the profitability part of the algorithm by sacrificing the scale part. The open question is whether they can ever get back to meaningful scale without reintroducing that same fatal risk. This is where the lock-in effect becomes the single most important factor, far more than the Fed's overnight rate. The real story, the one that should be dominating the analysis, is that existing homeowners who refinanced at 2.5% or 3% are not moving. They cannot. To sell their current home and buy another, even a comparable one, would mean swapping a $1,500 a month payment for a $3,500 a month payment. The only people selling right now are those who must, due to death, divorce, or a job relocation. This has crushed inventory to historic lows. Opendoor's entire model is predicated on a steady stream of available homes to buy. When that stream dries up, their algorithms have nothing to analyze, their funnels are empty, and their revenue evaporates. Wall Street is watching the Fed for rate cuts, thinking it will save Open. But a rate cut from 5.5% to 4.5% doesn't solve the lock-in problem. This is the disconnect. This is the reality that the market is ignoring. So, what does Opendoor actually do? For anyone who is new to the name, perhaps looking for investment help, or setting up an individual brokerage account for the first time, the concept is straightforward. They are the primary iBuyer, instant buyer. If you want to sell your home, you go to their website, enter your address, and their data models give you an all-cash offer, often within 24 hours. You skip the hassle of real estate agents, showings, and repairs. You pick your closing date, and Opendoor buys your house. Then they perform light renovations and list the house on the open market, hoping to sell it for a profit. Their income is supposed to come from this spread, the flip, and a service fee that is competitive with traditional realtor commissions. In theory, their data advantage allows them to price risk more accurately than a human and manage this entire process at an industrial scale. But as we've seen, that theory has some very expensive exceptions. Looking ahead, the path forward for Opendoor is one of three distinct possibilities. The bullish scenario, the expectation that holders on the SoFi investing platform are clinging to, is the soft landing. In this world, the Fed gently guides the economy down. Mortgage rates fall back into the 5% range, and the housing market thaws. This would be the perfect cocktail. Lower rates would incentivize more people to sell, feeding the Opendoor acquisition machine. At the same time, stable to rising home prices would ensure their inventory remains profitable. If they can pair this macro tailwind with their new, more disciplined pricing models, the stock has a credible path back to its old highs. This is the home run scenario. Then there's the bearish scenario, the reality that keeps professional risk managers up at night. This is a future where rates stay high, but the economy weakens, stagflation. In this world, the lock-in effect remains, so inventory stays at rock bottom, starving Opendoor of revenue. Simultaneously, a weak job market means home prices could start to roll over again, putting their current, smaller inventory portfolio back at risk of losses. This would be a devastating combination. The company's cash burn would accelerate, and questions about its long-term solvency would return. In this world, the $8.52 price is just a stop on the way to zero. This is the risk you take when you're using interactive brokers to trade a name this volatile. The interactive broker's fees might be low, but the potential for capital loss is immense. But there is a third, more nuanced scenario. This is one where Opendoor pivots. They recognize that the iBuying model, as a primary balance sheet heavy business, is simply too volatile. Instead, they lean into their platform side. They use their powerful pricing data and massive consumer funnel to partner with builders, agents, and institutions. They become a market maker in a different sense, connecting buyers and sellers and taking a smaller, asset-light fee. This makes them less of a Tesla stock and more of a Fidelity, a financial services platform for housing. This would likely cap the explosive upside as it's a lower margin, slower growth business, but it would also create a durable, profitable company that isn't at risk of extinction every time the Fed chair sneezes. This might be the most realistic outcome, and it's one that many investors, whether they are using a